Now, Kate Stalter.
Well, good Thursday morning to you here on today's edition of the Small Cap Roundup. I've put up a weekly chart of Apple right there in Tiger TV, and all I'm going to do in today's show, we're just going to track Apple tick by tick. We'll spend the hour discussing its market cap, and maybe we'll weave in some speculation of whether or not it should pay a dividend. So that's just what we'll do today. Just kidding. Of course, I'm a month early there on my April Fools. But definitely a whole lot of attention lately to Apple, just watching this thing climb higher and higher. So it is March. Let's take a look at how the indexes did in February. Let's start here with a look at the small cap Russell 2000, and let me pull that up on a monthly chart up there on Tiger TV. So for February, the Russell 2000 was up 2.3% on the month. Then we had the NASDAQ Composite, which for the month of February up 5.4%. And of course, a good chunk of that was due to Apple, of course, that was up almost 19% in February just alone. Let's see here. Let's take a look at the S&P 500. Let's see. The ticker here on that one is, there we go. There's the S&P 500. And for the month of February, you're seeing a gain of 4.1% up here. And of course, there's an Apple effect in the S&P as well, but other stocks were posting good price gains. ExxonMobil up 3%. That puny little company, ExxonMobil. So some good strength there from a number of places. And last but not least today, let's just take a look at the Dow 30 just for fun, up 2.5%. You know, you did have, of course, HPQ had that big drop-off after the earnings, but you did see some gains in IBM running to some new highs. McDonald's held up well. So you did see a number of the Dow components continuing to show good gains to offset some of that loss there in Hewlett-Packard. Okay, so look at some of the indexes, and because this is the small cap show, I will not leave the chart up there on the Dow. Let's put it back for the moment on our friend, the Russell 2000. I notice we have Ben Bernanke testifying again for the second day up at Capitol Hill. A friend of mine tweeted something funny yesterday regarding the intraday reversal in the indexes as Bernanke was speaking. I think he tweeted something along the lines of "No Uncle Sugar today," and that just made me laugh because so many of the traders obviously were looking for some further comment about QE3, wanting some more money to put to work, but that, according to what Bernanke is saying, did not appear to be forthcoming. So no Uncle Sugar there yesterday. So he's speaking again today, and so far indexes trading a bit higher. Some good retail sales figures released this morning. So there you have it. Indexes trading higher on the day. So it is March, and that means the almost three-year anniversary of that bull market that began back in 2009. I'm indicating it there on Tiger TV. I remember that so well as we were emerging from that horrible time in late 2007, 2008, early 2009. And of course, just when things appear to be the worst, when everybody's completely discouraged and demoralized and stocks were sinking to new lows, I recall there was some good data about the financial sector and the markets were off to the races. I distinctly remember that even as the rally was confirmed with some heavy volume, as stocks were trending higher, you heard a lot of the pundits and the so-called experts were kind of dithering and debating about whether the rally was for real, and a lot of them ended up missing out on some of those really good gains back in 2009. So that's what happens if you kind of don't follow what the market action is actually telling you and go by some kind of opinion or somebody's forecast. It really is about trend following, doing what the market's price and volume action are telling you, using these very simple indicators some key moving averages. Just follow those. And, all these economic prognostications, you hear them all the time. I hear them all the time. And sometimes it just, really, frankly, it drives me nuts because nobody really knows. They're guesses. Maybe you can call them educated guesses because you're using some fancy mathematical models. But there's really just too much chaos, too many unexpected events, and emotion, of course, panic and jubilation that factors into the markets. When I was down at the World Money Show in Orlando a few weeks ago, and I was speaking with the editor of Barron's. I got a great opportunity to interview him, and I did ask him the question, because they have this famous forecast they put out there on the front of Barron's a few weeks ago, Dow 15,000, and they're talking about a 2-year time frame, if I'm recalling that correctly. I asked him, though, about the Black Swan events, and he made a great point. He said you really can't call them Black Swan anymore because these so-called quote-unquote unexpected events just really do happen with some regularity. So the safest thing to do, and nothing wrong with being safe when it comes to your money, taking appropriate risks based on what the charts and the market trends are telling us, combined with the stock's own fundamentals. That's what we do here on the Small Cap Roundup. So no economic prognostications or grand forecasts that somebody pulled out of thin air. I want to share something I read last night. It was a book review of all things from Success Magazine, and this was a review of the new Jim Collins book. And for business book junkies like me, you may have read Jim Collins' Good to Great and Built to Last. His new book is called Great by Choice. And here's the paragraph that reminded me of some of the parallels between running a business and running your own discretionary trades like a business. So here's what it says. It may come as a surprise to learn that the most consistently successful leaders are not extreme risk takers. Rather, they are extreme planners who persistently work to anticipate worst-case scenarios, practice constantly for success, and base their actions on sure foundations of established research and data. In Great by Choice, Jim Collins and his co-writer reveal that companies they refer to as 10Xers, those that consistently outperformed comparative firms by at least 10 times over a period of 15-plus years, are actually more driven by discipline, empiricism, and paranoia than their counterparts. So, okay, close quote there. So we definitely will be using data here to make our decisions. That's the empirical part. We'll be disciplined about our trades, and no shame at all in a healthy dose of some paranoia when it comes to protecting your market. So let's go ahead and turn to some charts today. I'm going to put up a chart here. FNSR is the ticker, and we talked about that right at the end of Tuesday's program. And I've got that on a monthly there on Tiger TV. I'm going to put it back on a weekly. Okay, there we go. So Finisar, we were talking about that a little bit on Tuesday. This company missed third quarter estimates, and it issued a disappointing outlook when it reported after the bell. And it's often the outlook more than the actual report that affects the stock. So the fundamentals of this one, we didn't really have too much time to get into it there in the last couple minutes on Tuesday. The fundamentals had actually deteriorated prior to the earnings report. So you already had a situation there that was less than ideal. And this company, by the way, does make networking gear, fiber optics gear. They were a leader at one point. They had a great year back in 2010. 2009 had some good gains. Really have been suffering quite a bit in 2011 onward. And it's down about 14% so far this week. Now, looking at the chart, there's a little glimmer of optimism. I do see that it's getting some support right there at the 40-week line. So maybe it will continue to find support there, shore up a bit above the key moving averages and resume a rally. But those moving averages are going to be the key right here to watch. Now, also on Finisar, the fundamentals are expected to improve in 2013. Earnings of $1.33 a share, so that would be almost a 50% gain. Let's see, about a 48% gain. in earnings growth in 2013. So if that actually does seem to be panning out, and again, back to my theme of no prognostications, but the analyst estimates do show you the degree of confidence that the institutions have in a stock at any given moment. So that is interesting to track. It is valuable to track that. So if this earnings growth does pan out or show up to be better than expected, you could also see some further technical improvement in this stock in the coming months. Let's see here. I'm going to put up another ticker there on Tiger TV. This is Kodiak, and I talked about this on Tuesday. It did just report earnings. Now, this is in the ranks of the low-price stocks. It's trading at about $9.73. It did gap down after the report. I'm going to just briefly put it up here on a daily chart. So it did gap down, but is getting a bit more support today. I'll put it back on a weekly to give us that perspective. It missed earnings estimates, but revenue has been growing at triple-digit rates. And, of course, it did decline in some pretty big volume. That's typical, what you're going to see when a stock gaps down. You are going to see some heavy volume. Not looking great, but again, you are seeing support right there at that 10-week moving average. So once again, a situation where the moving average support could be critical. It is just so interesting that you do see these big moves up or down on a particular day. Particularly now we're talking about the downside moves where you do get support at that 10-week or 40-week line. And while a stock can really be devastated on the short term, in the longer term, for those really willing to watch the pattern take shape, it could offer a buy point in the not so distant future. So I'm still liking Kodiak here as one to watch. I think we just need to be a little bit patient with it. Even though the earnings did come in disappointing this time around, we're looking at what analysts expect to be huge earnings growth in 2010 and another big jump. 2012. I was looking at the jump in 2011 over 2010, which was also huge. And analysts are expecting the same thing to happen again in 2012 over 2011. Triple-digit growth, actually more than 700% growth from what I can see on here, and then another 50% to 2013. You know, this is a company that, as I mentioned the other day, has most of its reserves in oil and also some in natural gas. It has been making some acquisitions. So definitely some bright spots anticipated ahead for Kodiak, K-O-G. Okay. We are winding down this segment. We have coming up later on in the show another terrific fund manager, David James from the James Small Cap Fund. Stick around because you'll really want to hear from him. Looking forward to talking with him. Thanks so much for listening today. We'll be right back with more of the Small Cap Roundup after this break.
You've always taken the long view when it comes to investing. But what if there's an opportunity right under your nose? What if you could be more responsive to market trends to seek to boost your portfolio performance right now while actually reducing your overall risk? At Direction Funds, we connect investors with alternative strategies that seek to maximize their returns, making missed opportunities a thing of the past. Smart investors deserve smart alternatives. Find yours at directionfunds.com. An investor should consider the investment objectives, risk charges, and expenses of Direction Funds carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Funds. To obtain a prospectus or summary prospectus, please contact the Direction Funds at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. Investing in index funds may be more volatile than investing in broadly diversified funds. Distributed by Rafferty Capital Markets, LLC.
TFNN is proud to bring you the cutting edge of investment newsletters. Ken Shreve's Ultimate Growth Stocks. Ken is a top-down investor who lets price and volume in the major stock indices tell him when to be in the market and when to be out. By using his unique blend of fundamental and technical analysis, Ken will protect your hard-earned capital while realizing breakout gains. Go to TFNN.com today, click Investment Newsletters, and get Ken Shreve's Ultimate Growth Stocks free for 2 weeks.
Hi, I'm Steve Rhodes, co-host of The Money Masters with Tom O'Brien, seen daily at TFNN.com, author of Mastering Probabilities, a daily investment and trading newsletter, and teacher of the money game. Studies show that 3 out of 5 people are afraid for their life in trading these markets, and the number one reason given is fear of loss. Look, fear stands for false evidence appearing real, and the money game proves it. Lesson number 1, don't risk more than 1% of your trading capital on any trade. Why, you ask? Because 35 trades in a row where you risk 50 cents and make $1 are all you need to double your trading capital, versus the 230 losing trades in a row you would need to bring your balance to $100. Let me teach you more about the money game risk-free for 30 days. Go to the homepage of TFNN.com and click on my name, Steve Rhodes, for your 30-day risk-free trial. You were born to be a money master, and I'll teach you how.
X-Story Gold Mines, an NYSE Amex-listed company trading under the symbol XG, is slated to be the newest gold-silver producer in Argentina. X-Story is forecast to produce more than $250 million in bullion annually, beginning in 2013, at a cash cost of less than $200 for each ounce of gold produced. That forecast will make X-Story one of the highest margin operators in South America and a sector leader in the mining industry. X-Story has $50 million in its treasury, having spent over $60 million to date on drilling and engineering. The ultimate size of its Argentina discovery could be determined by year-end, as results from the 6 drills operating at the site are fully assessed. To find out more about X-Story Gold Mines and their exciting growth potential, click on their banner on the front page of TFNN.com or check them out on the NYSE Amex under the symbol XG.
Here's what people are saying about Tiger TV.
Let's go to John in Tampa. Hey, John, what's going on?
Hi, Tom. How are you, sir?
I'm doing great. You having a good day out there?
A wonderful day. I love your Tiger TV. I watch it every day. I'm like a kid in a candy store.
Oh, man, I appreciate you out there watching it. How long have you been watching the Tiger TV?
I'm watching almost a month now, and it's wonderful.
It's pretty cool, isn't it?
Oh, yes, it's cool. You see the charts and everything. Thanks so much for the hard work.
Tiger TV, a great news service from TFNN.com. This segment is brought to you by BackTech Environmental. For more information, just click the BackTech banner on the front page of TFNN.com.
All right, back with our next segment. I'm Kate Stalter. This is the Small Cap Roundup. I've put another chart up there on Tiger TV. The ticker is CPIX, Cumberland Pharmaceutical, and this is a very small company, very small market cap of about 154 million, trades about 44,000 shares a day. And this company makes prescription drugs to treat pain and some digestive ailments. So this one reported earnings after the close on Wednesday. Now you see that it had been kind of wrestling with this high from back in December of 2010. Its high price back there of $8.18. That's 818 area code in the Valley up there in Los Angeles, but 818 was the high price back in December 2010, and it's kind of been bumping up right against that. Let's see, it rallied to 802, and then this week got as high as $8. So it missed by a penny. It guided the full year below views. That's never a good omen for a stock. But take a look at this. We're looking at this on a weekly chart. There's your 10-week average. So even with a pullback there on some what you could call disappointing results on the quarterly earnings report, look how far above that 10-week line this one's continuing to hold. So while a miss like that is never a good sign, this one does continue to hold up well. I really would like to see it get back up near this 818 number before we try to do anything, make any kind of purchase on this one, just because with a small stock like this one, I mean, if you're talking about something that's trading 44,000 shares a day, so far so good that it didn't make some kind of huge pullback and slice that average. So I want to see this move up a little higher. I want a little more assurance, so to speak, if such a thing exists in this particular stock, just to take a little bit more of a conservative approach. Okay, let me go to another one here that we've talked about quite a bit on the show. This is Anika Pharmaceuticals, A-N-I-K, and this is one I've been tracking for quite some time, and it previously had offered a buy point. If you look back here, when the 10-week line crossed the 40-week line for more aggressive investors, that could have offered a good opportunity. Now, this company makes products to treat cartilage and soft tissue ailments, and this is also a small one. Market cap of $168 million, only moves 54,000 shares. So again, you do have some of that very small company risk to consider in this particular name. There was a point as well to add some additional shares where it kind of was getting some 10-week support back here and bouncing off of that line. That would have been another point. So now, what would have been the decision here with this particular stock with regard to the earnings report? Because as I say a lot, it's very, you can be, you can keep more of your gains if you do decide to sell some shares ahead of the earnings report. A lot of these companies just can get smacked down hard, and as I've shown several times recently, you're even seeing it with big cap, blue chip Dow components, HPQ. Got smacked down on a disappointing earnings report. The same thing happened with Dell not too long ago. So, the risk can be even more acute with some of these very small, very thin companies. So to keep consistent with my view of using some extra caution with the smaller, more speculative names, I would have taken some money off the table ahead of the earnings report and kept some gains. There will always be another chance to enter, or another stock will come along. Do you risk the possibility of leaving some profits on the table? Yeah, you do. And that's what would have happened here. But getting greedy can really put a serious dent in your trading profits. So that's a temptation to be avoided. And that's not always something that's easy to do. Now, Anika trounced its earnings and revenue views. It got an analyst upgrade. So you just want to watch for the next little technical pullback. And I would think that this would continue to get good support above that 10-week line. That appears to be the trend here. So there could be a new buy opportunity on the next pullback. I do consider this too extended at this moment. I have time to show you one other here before our break. And this one reports in a few weeks, March 19th, I believe. This is Manitex International. MNTX is the ticker on this one. And this makes cranes and some of those lift vehicles designed to lift heavy loads. So it could have offered a buy point back here for more aggressive investors. So this is one that I just want to keep an eye on ahead of the earnings. Nice little pullback here, could offer a pre-earnings consolidation. There's my music. Stick around. We will be back with David James here on the Small Cap Roundup.
This is Tom O'Brien. If you want to get great trade setups in the equity as well as the option market, come over to TFNN.com and test drive my daily newsletter, Market Insights, for 2 weeks absolutely free. Each trade setup comes with a profit projection as well as stop placement. Included in Market Insights is a Twitter alert service. This allows you to take advantage of intraday setups. Volatility is back in the markets. What does that mean to you? To me, it spells short-term opportunity each and every day. The days of trending up on lighter volume are gone. We have come off the highs with volume across the globe. Don't get caught in a complacency trap. Many of the indices have given back 2 months of trading in 1 week. We have a trader's market. You can take advantage of this trader's market by test driving my daily newsletter, Market Insights, free for 2 weeks. Market Insights will give you the edge you're looking for in the markets. Go to TFNN.com under newsletter. Hit the Market Insight tab for your 2-week free test drive right here, right now.
In just December of last year, the price of gold was down over 10%. In today's highly volatile gold market, you need someone in your corner that understands the complex relationships that exist within the price of gold, as well as within a variety of gold equities. Whether it's the South African gold miners and knowing how the rand-dollar relationship will affect their bottom line, or understanding how John Paulson's $5 billion trade in the GLD can move the market, Tom O'Brien gives you the direction you need to become a better trader each week in his newsletter, The Gold Report. With over 20 individual equities covered and almost another 20 on the potential watch list each week, in addition to covering the XAU, HUI, GLD, and dollar, The Gold Report is a great source for any trader that is looking to be diversified in today's volatile gold market. For your 30-day free trial to Tom O'Brien's Gold Report, log on to TFNN.com today. Don't miss out on this great offer. Act now. In the world of financial markets, there's a new player in town with an exciting new way to trade the markets. Nadex now offers binary options as well as bull spreads in a wide range of indices along with commodity and forex markets. With as little as $100, you can gain access to a new way to trade global financial markets while guaranteeing that your risk will always be capped. Nadex allows you to multiply your trading opportunities in ways never imagined before and access markets you once thought were out of reach. With short-term trading opportunities available, including binary options expiring each hour the market is open, Nadex allows you to take advantage of a variety of market conditions regardless of volatility or market direction. Now is the time to take advantage of this exciting new market. Don't let this trading opportunity pass you by. Open your account today by clicking on the Nadex banner on the front page of TFNN.com. Nadex, a better way to trade.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Smith Barney. Simply picking the right stocks is not enough. Research has shown that choosing the right proportion of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley Smith Barney believes that a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what asset allocation and a Morgan Stanley Smith Barney financial advisor can do for you. Call Angela O'Brien, First Vice President and Certified Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Smith Barney, LLC. Member SIPC.
This segment is brought to you by Harmony Gold. For more information, just click the Harmony Gold banner on the front page of TFNN.com.
So one of the things that I really like to do here on the Small Cap Roundup, if you've been listening to the show, you know this, is bring on some of these fund managers who are investing in some of these small cap names. And we as individual investors have the luxury of being able to watch what they're buying and selling and follow in their footsteps. But it's just great to hear the professional's perspective on what goes into a good portfolio. Today, we're welcoming David James, one of the managers of the James Small Cap Fund, JASCX. Is the ticker on that one. And David, I'm looking at the track record. You've got a terrific record going back 10 years, particularly in the past 3 years. How are you doing that? Tell us how you're finding this kind of success.
Well, thank you very much. And what we have at James Investment Research, when we're looking at our funds and what we're trying to do is we buy what we call bargain stocks. And specifically what we're looking for are stocks that will have a good relative value. We want to find companies, of course, that their stock price is trading relatively cheap compared to, say, their earnings or their cash flow. And we combine that with companies that are profitable. And we're looking, of course, at their earnings, what has happened there, if any growth there. But as people, I think, know, a lot of times it seems like companies find ways to manage their earnings, so we find other ways to measure profitability. And we'll look at things like return on assets or its cash flow from operations. If we find those two components, we know that we're really buying a good company or a good stock. But we combine that with the idea of long-term relative strength. And my father, Dr. Frank James, who was the founder at James Investment Research, he's the one that really pioneered this concept back in the 1960s, and it's what he did his doctoral dissertation on. And basically it says that if you find a company that it's outperforming the market over a long period of time, it generally will continue to outperform the market. And we find that kind of tells us that's when to own it. So if we can find companies that are cheap and profitable and that they're outperforming the market, that really says it's a bargain stock to us. And that's, like I said, kind of part of the big secret of what we try to look for.
Now, David, I'm looking at the asset allocation from the fund on the most recent Morningstar data, and I noticed that you're really almost exclusively in U.S. stocks. Is that indeed still the case?
That is the case. We think that there are times where international stocks can do extremely well. But we find that, as far as within the small cap arena, there's just so many good names here in the United States that really is where we like to focus. We won't, hold it against a stock if it's from Canada or Japan or anywhere else. But, we're just concerned with finding the best bargains. And, the research that we do suggests that, probably this year the dollar will once again start to strengthen, that the problems over in Europe will start to create more of a need for the dollar again. And as that happens, that really favors a lot more of the American companies, and especially our smaller cap stocks. You consider, like, if you were to look at big cap stocks like those of the S&P 500, they get over 40% of their sales come from abroad. So if we do see a stronger dollar, it might be harder on some of those larger stocks, and many of the smaller stocks, they just don't have to have quite that international component to do well. And we just think that, like I said, it's just a good sweet spot overall for them if you have that ability to find those bargain stocks.
Now, one of the strong sectors in recent months has been consumer, and I noticed that you, again, at least going back to the most recently reported quarter, you did have a pretty heavy weighting in consumer cyclical. Do you still?
We do. And again, this would be an area where we like what we can see within here. We think that some cyclical stocks will have problems, if they have a lot of exports that they rely on. But, some of the ones that we would have in ours would be like Domino's Pizza. And obviously, you don't go over to Europe and hope for somebody in New York to get that over to you anytime soon. And, another one that's been a big winner for us has been Polaris Industries, the ones that, that they've done, like the snowmobiles and the like, and we're very sorry that it seems like that one we're actually having to sell right now. It's been a wonderful stock, but we want this to be a small cap portfolio, and the stock's done so well over the years that now it's more of a mid cap name. So we're having to sell out of that, but we continue to look for some of those good bargain names.
Right, and Domino's is one that I've highlighted on the show, and I've been tracking Polaris for quite some time myself as well. Well, David, that brings up a point then. What market cap range are you looking at when you make a purchase?
We like to be in stocks that are in the size of the Russell 2000 or smaller. And, we will include some of those micro-cap stocks in here where they're appropriate. And we think that that's a good thing. The only problem you have is come June or July, the Russell 2000, that they shake up all the stocks in their portfolio, and, at that point they can change as far as, what size that is. But right now that would be stocks that are about $3 billion or smaller would be what we would be looking at. But generally speaking, we like to find the smaller ones because we found that over the years, the smaller that you go, the more inefficient the stock market is. And that, I think, works out for active investors, that it works more to their advantage if you have a good approach.
And I guess some of the other small cap managers we've talked to on here have said some of the reason for that inefficiency is often because these smaller companies are not really in front of Wall Street going back to look for either more debt or equity financing, so they don't have analyst coverage. Do you agree with that?
Yes, and we think that that really works very much into their favor. The analysts on Wall Street, they're very, very smart people, but they often get that herd mentality, and that can, actually hurt investors by following that. One of the things that we find, if you look at just the last 10 years, but it's really been true even going back into the 80s or before, that if you were to invest every quarter in the companies that Wall Street analysts have the highest earnings projections for the future, that you would end up losing about 1.5% a year. Whereas if you went to the ones that Wall Street said, oh, these are the ugly ducklings, the ones that have the lowest earnings projections, they made close to 8% a year. And so, by being able to be a contrarian and, having, looking at the data instead of, looking at the projections, that really seems to make a big difference. And as you pointed out, when you get into those smaller companies, fewer people are following them. So, there are things you can find out about them that really make a difference as far as their future performance.
That's a really interesting point, David, because just in my own experience as an investment coach over the last decade or so, I have noticed that the estimates do seem to often reflect price strength at a given moment. But also, you have to be very careful in how you balance that, because sometimes a stock can tumble right when the fundamental estimates are the strongest.
Exactly, and I think that's part of what happens within this is that if you take the companies that have had the lowest earnings projections, basically they've already disappointed Wall Street, and from that standpoint, there's very little more disappointment to happen, and that there's actually that chance for them to really do well, to surprise on the upside. Whereas the companies that Wall Street's expecting to do well, they've typically already done well. And that outperformance time for them, at least on their earnings front, might be coming to an end.
And for individual investors, obviously, they can sometimes be more nimble than a fund, but you have to track these very closely nonetheless.
You really do. And the other thing that I think that individual investors can have an advantage over, some of the professional analysts is, again, that the analysts, they tend to have a bias towards wanting to buy. They'll have, this is a good stock, this is a good stock. And we find today that they're averaging over 12 buy recommendations for every one sell recommendation. And the part that, I think investors can do well is you don't have to be a high turnover trader, but you need to have an active approach and probably spend more time on the sell discipline, actually, than on the buy discipline. If the stock is no longer a bargain, then that's time to go ahead and part company. And it's not saying that it's a bad company. That's the other key, is recognizing the difference between a good company, a good stock. But having that sell discipline, I think, is really the other key.
Well, let's talk about that a little bit. How do you and your fellow fund managers over there at James, how do you make those sell decisions?
Well, we have several things. One of them is, we try to take a quantitative approach as far as, like I said, looking at what are bargain stocks. And, we've scored them on a basis of 1 to 100. And we have over 8,000 stocks that we track, and we're updating that data about 3 or 4 times a month and looking at it. And if a stock falls out of our top 20%, we actually go back and we get our investment committee together and we start saying, is this company or is this stock really still a bargain? It's not saying that it's automatically sold, but, that really brings out the question to us that we need to start looking at it closely at that point. And we think that that's a good way of doing it. A lot of people like to focus on, a certain price target and sell at that point. But, just because a stock price has gone up, their earnings may have gone up even more. It still may be a bargain stock. So we prefer to, like I said, kind of compare them versus all 8,000 stocks and see if it remains a bargain. And, by doing that, it, like I said, helps us to keep focusing on that sell discipline. And the other part with that is that, we like to reward our winners as well. So if a company is doing well, doing what it's supposed to be doing, we will continue to buy shares where it's appropriate. We still want to remain diversified, but, by selling your losers, it's a really good strategy, because if you don't, you keep taking profits from those good companies and maybe they're still bargains. If you sell nothing but your good companies, you end up with a portfolio that's left with nothing but losers. And we find, that's very easy to do because of emotions and everything else. And you really, like I said, you need to have that analytical method of, evaluating a stock and what's happening there and trying to keep the emotions out as far as what it has gained or what it has not gained.
Which, again, is some great discipline that individual investors can learn from the pros. Very well stated there, David. Thank you for saying that. Let me turn to, we have a few more minutes left here. I just want to ask you a little bit about some of the other sectors and maybe some names within those sectors that you like. How about the industrials? It appeared that you had a pretty heavy weighting there recently.
Yes, and industrials, there's covers so many different things, and one of the companies there though that we've liked has been Strum Ruger, and they're the ones, of course, that make guns, and it seems like there's been a big demand for that, and that has been a really good play. But another one that I think is surprising to people is Americo, which is the ticker for U-Haul. And that's exactly what it is. It's U-Haul. And it seems that more and more Americans are wanting to move things from place to place. And that's been kind of a surprising up-and-comer as far as stocks that we've liked.
David, what's I'm sorry, what's the ticker on that one?
For Americo?
Yes.
U-H-A-L. U-Haul.
Oh, okay. U-H-A-L. Okay, there we go. Great. All right. Okay.
And, again, we just found that, these are great niche plays, and usually within small cap names, you just don't find names that you've ever heard of before, but that's one that people actually have.
Right, and Storm Ruger is one that I've shown here on the show many times as well, put up that chart. Now, this is interesting on the Americo. That's, definitely pretty thinly traded. Now, is that unusual for a fund like yours to get into a stock that moves so few shares?
Yes. One of the parts that we really try to make sure that we do when we're looking at companies is we don't want to really get into ownership issues. So we will limit ourselves, generally speaking, to no more than like about 7% of the company's outstanding stock. But the other side of it is, when you're owning a stock, you want to be able to get out of it eventually. So we typically limit ourselves to no more than about 5 days trading volume. Mm-hmm. And as you point out, if you have something that's a little bit more thinly traded like this, it does mean that, we might reach certain limits. And in fact, for a while, we did have that happening where we weren't able to buy new shares of Americo. And just recently, the volume picked up enough that we're able to start buying more. And indeed, that's what we've been doing.
Interesting point there about the position sizing. That's great. Any other stocks there? We have about a minute left, David. Any quick names you could talk about before we wrap up?
Well, we talked about some of the really good ones. Within everything else, it's so hard to say. We think that, like I said, the ones we've talked about have been really good. There's wonderful things that are happening, like in high-tech pharmaceutical. Ticker is HITK. Again, it's in the non-cyclical. They do a lot of things there with generic drugs. That's probably one of the ones that I think is really one of the better plays that probably doesn't get discussed enough as far as within what's happening within healthcare and the like. So, that's the big thing is you want to own a whole basket of these companies because you never know exactly which one's going to be the right one. And one other one that probably like is Easy Corp, and the ticker is EZPW. And Easy Corp does pawn shops. So in this kind of economy and everything else, and with what's happening on cable TV, talking about some of those pawn shops, it seems like they're getting more interest, and that's also a good play as well.
Hey, David, this has been awesome. Thank you so much. We're definitely going to have you back sometime. Really enjoyed this.
Thank you much.
All right, stick around. We got one more segment here on the Small Cap Roundup.
At Tiger Metal Exchange, we pay you more for converting your jewelry to cash.
Let's go to Brian in New Jersey. Hey, Brian, what's going on?
Hey, Tom, just want to let you know I did give you some jewelry. My jeweler offered me about $650. Let you get a check in the mail tomorrow for about $1,200.
At Tiger Metal Exchange, it's all about honesty when converting your jewelry to cash.
Okay, let's go to Paul in Florida first. Hey, Paul, what's going on?
I want to commend you on the Tiger Metal Exchange. I just did a deal with you guys the other day.
Oh, Oh, good.
And very happy.
Well, I appreciate it. Now, did you sell us jewelry or did you buy coins off us?
I sold you jewelry.
Okay.
Yeah.
Awesome.
What we weighted at was less than you guys said, so, you're totally honest.
At Tiger Metal Exchange, we give you the tools to value your gold, and it's absolutely free. Call 866-618-8888 or log on to TigerMetalExchange.com. We've created the easiest, safest, and most honest cash for gold process. Tiger Metal Exchange. It's the only call you need to make.
Put the power of the Chapman Wave methodology to work for you. No matter what market you trade, what time frame you trade in, or your trading style, the Opening Call, Basil Chapman's daily market newsletter, is bursting with the information and trades you need to become a more successful trader.
I've been using Basil Chapman's Chapman Wave methodology for several years now. His Chapman Wave can be used for any time period for not only equities, but futures, currencies, commodities. I've been also a subscriber of his Opening Call, which I find an invaluable tool to help me analyze the potential of the market each day. He gives you opportunities to go short and long. It includes recommendations on stocks. I strongly recommend people using the Chapman Wave, and I very, very strongly support the use of his Opening Call.
To find out more about Basil Chapman and his Chapman Wave methodology, and to get your 2-week free trial of the Opening Call, a $64 value, visit tfnn.com today.
Would you like to discover the next great tech stock? David White, TFNN's technology guru, has just launched his new newsletter, The Technology Insider. In his newsletter, David will be looking for those shining stars that may turn into the next Apple, Microsoft, or Cisco. David combines his technology background as a software programmer with his market skills as a successful professional trader to give you this unique newsletter. We're on the verge of the next great tech run. With the Technology Insider, you'll be in front of the run-up and not lagging behind. David is developing a long-term investment portfolio. Therefore, we're only offering the Technology Insider as an annual subscription with a remarkable price of only $395. That's right, for a little over $1 a day, you'll receive the fundamental technology wisdom and technical trading skills of the Technology Insider David White. What are you waiting for? Go to the front of TFNN.com, click on the link on the front page, sign up for your 2-week free trial, and become a Technology Insider today. Great Basin Gold is a mining company engaged in the exploration and development of 2 emerging gold properties in Nevada and South Africa with a total resource base of more than 23 million gold ounces. Great Basin's Burnstone mine in South Africa opened in February of this year with a resource of 20 million gold ounces, becoming the first mine to open in the historic Witwatersrand Basin in the last 30 years. The Burnstone mine is projected to have a 25-year mine life and is fully financed with production anticipated to be over 250,000 ounces per year at a cash cost of only $450 per ounce. The Hollister mine in Nevada became fully integrated in the 4th quarter of 2010 with annual production estimates of 110,000 ounces of gold per year over the 8-year mine life at a cash cost of only $527 per ounce. Great Basin Gold is cash flow positive and trades on the Toronto and New York stock exchanges under the symbol GBG.
Catch Larry Pesavento, a 40-year veteran trader. He uses pattern recognition, Gartleys, butterflies, ABCs, and Fibonacci in order to trade these markets. The Futures Hour, next on TFNN.
All right, our final segment today here on the Small Cap Roundup. I'm Kate Stalter. What a great conversation that was with David James of the James Small Cap Fund. So many great bits of information there. One thing I really enjoyed was the discussion of the position sizing on some of these smaller stocks like the Americo, UHAL, the U-Haul company there that he was discussing, and just how they determine how much to invest in a company like that that only moves, right now looks like 28,000 shares a day on average. Because that's the kind of thing funds, as he noted, they do have to be very careful about what they do on those, and as individuals, we do too. So that was pretty interesting. A lot of great information in there. Before we go today, and I've got a few more minutes, but I wanted to remind everybody there is a Tiger Dollar promotion, and it runs through March 11th. You can get the details about that on TFNN.com. So be sure to check that out. Those are terrific promotions, and you want to be able to take advantage of those. You also can get access to Tom O'Brien's webinar on March 29th. So take a look at TFNN and make sure you get information about all those terrific offers. So let's see. I wanted to put a couple more tickers up here before we go today, just with regard to some of these earnings reports. I just put a ticker up there, INXN, Interaction Holdings. I guess that's how you pronounce it. It's a Dutch server farm operator. So kind of like Rackspace or maybe HostGator or GoDaddy or something like that. The company went public a little over a year ago. It reported earnings after the bell on Tuesday, so earlier this week. It got a nice price boost on Wednesday. Let me just put up a daily chart very quickly here on Tiger TV. So there you see that was Wednesday's action, and we're getting another gap up higher there today. In fact, so I'm going to go back to a weekly chart. So one thing, obviously, this price action recently has been terrific. You did have that bullish cross here with your 10-week average crossing above your 40-week. However, this is rather a sloppy and erratic chart. Let me see if I can give you a little longer view of this there on Tiger TV. No, not really. It's harder with some of these newer stocks. No, I really can't. I'll put it up on a monthly, though. And you can see how it's been looking on a monthly basis. So you can even see these wide monthly price swings. So it's been basically one long, messy consolidation. It did clear its previous high. Volume was diminishing on the run-up here. I don't know if you can kind of see volume, see it barely down there at the bottom of the chart on Tiger TV. And the reason that it's hard to see is because there wasn't much volume. And that's not a great thing. Of course, you did see that in the major indexes recently, and a lot of stocks were just reflecting what the broader markets were doing. That was more pronounced really in the NYSE indexes than on the NASDAQ. So this one is in technical buy range now. It's got a few good points to it, but I'm not super excited about it because you had some. I'm going to go back to a daily chart and just show you something here. Yeah, see, you saw heavier daily volume here on that big move yesterday, and then obviously today we don't have the completed daily volume yet, so it'll probably come in heavier. Looks like it might, but you didn't really see terribly heavier volume on this particular move, so not really too much excited about that. So it might show some lukewarm conviction about the stock at this point. One more. Oh, I guess I can. I'll show you this. We'll talk about the next one on Tuesday. Bioreference Labs I wanted to show you. I can't believe how quickly these shows go by. I'm Kate Stalter. This is the Small Cap Roundup. We'll have lots more small caps and, of course, more Apple news, I'm sure, next week. Thanks for listening.